Greetings and welcome to today's webinar, Corporate Issuers and the ESG Dilemma. I'm Ron Loch, Managing Director of Sustainability Consulting for GNS Business Communications. We're a full-service communications agency with a dedicated practice for helping firms improve stakeholder engagement around ESG issues. And before I introduce our guests, I'd like to go over our webinar platform. Throughout the presentation, you can submit Q&A to the speakers through the Q&A pod that is in the bottom right-hand corner of your screen. You can use this pod as well if you have any audio or technical difficulties. Just put your message in there and send it to us, and we'll have someone contact you. To maximize your view of the slides today, use the exploding arrow key that is up in the top right-hand corner. And if you are calling in, please mute your phone so that you don't disturb the speakers. So now I'd like to introduce our guests for today. We have Susan Sheehan, Vice President of Sustainability for GNS Business Communications. Susan helps organizations evaluate ESG performance, develop sustainability goals, and enhance investor engagement through targeted communications. Susan has trained with the Global Reporting Initiative, the Sustainability Consortium, and is an FSA Level 1 SASB candidate. Susan earned a BA from the University of Western Ontario and an MBA from the Richard Ivey School of Business. Welcome, Susan.
Thank you, Ron. Nice to be here.
And joining Susan is Eric Fernald, an Executive Director at MSCI. MSCI is an independent provider of research-driven insights and tools for institutional investors with deep expertise in the areas of risk and performance measurement. Eric is also head of MSCI's ESG Research Corporate Communications Program and is on the MSCI ESG Research Ratings Review Committee. He holds a BA in Political Science from Williams College. Welcome, Eric.
Hi, Ron.
So what is this ESG dilemma? Well, investors are increasingly asking questions about the information they're receiving from issuers around the risks and opportunities associated with environmental, social, and governance concerns. And despite a growing number of companies issuing CSR reports and dedicating websites to sustainability stories, they're coming to the conclusion that they need better information. Now, you may be wondering, is this sector, or perhaps your C-suite is also asking the question, is this sector of investors really that important? And the data really would say they are. ESG impact investing is on the rise in the U.S. It's growing by 33% from 2014 to 2016. But perhaps even more importantly, ESG performance has now infiltrated the traditional investment models and screening for risks, management quality, and opportunities of all issuers. I think it can be argued that the integration of ESG into investment decision-making has hit an inflection point, particularly when you consider that signatories to the Principles of Responsible Investment Initiative represent a combined assets under management of $59 trillion. So why is this? Why is so much interest in ESG disclosure and in investing in more sustainability conscious companies increasing? And it's really threefold. Largely, one is because the companies that disclose have been shown to outperform their peers. For example, when you compare Carbon Disclosure Project leading S&P 500 reporters versus those reporters considered as lagging, you find that leading reporters deliver an 18% higher return on equity, experience 50% less volatility of earnings, and pay higher dividends to shareholders. And this interest in ESG disclosure is particularly true for investors that take a long-term view. Harvard University did a study and they compared portfolios, and what they found is that an investment in a high sustainability portfolio in 1993 outperformed a low sustainability portfolio by 46%. But I know recently, particularly since January, a question I've been getting from companies is that in this environment of US deregulation, is this interest going to wane? What is going to be the response of these institutional investors who have had this interest in ESG disclosure? And I think you can make the argument that the evidence is pretty clear that perhaps the response is going to be by holding issuers even more accountable. Almost on a daily basis, there are headlines that suggest this to be true. And if that is true, companies are really going to have to take, a keen look at how they are representing their ESG activities, risks, and opportunities in all of their disclosures. But Eric, you compile this information. I'd like your opinion on, in this era that we have right now, with a focus to deregulation, what do you think the demands on ESG disclosures are going to be?
I think they're going to continue to rise, despite the recent political developments. I think these are global trends, first and foremost. So for many of your listeners, they'll be facing continued demands globally, especially in Europe and now even more in the Asian markets. I think as well, as you noted, the driver for this are large asset managers, asset owners who are really taking a long-term perspective and have a long-term value creation view, and so greater disclosure fits into their model, and so I expect the demands to continue to grow.
Well, great. Well, that leads us to Susan then, who's going to take a look at what the ESG disclosure landscape is currently and how that is either meeting or perhaps not meeting the demands of these analysts. Susan?
Thank you, Ron. I thought what I would do in the next handful of minutes is really focus on what's happened most recently and how that could shape what's going to happen in 2017. This whole world of ESG disclosure has been developing for 15 years. So even though it's flown under the radar screen probably for the last 13 years, it's really been about developing capacity as an industry, both on the issuer side and on the institutional investor or overall even retail investor side, getting a sense of how to do this and how to integrate ESG into decision making. And I really believe that 2017 is when we're going to hit the ground and see the application being much more visible by very sophisticated investors on the institutional side and even more and more on the retail side. So the first thing I wanted to share with you are the results of the survey of institutional investors being asked, what do they have in mind for 2017 as it pertains to governance? And the topic that came up highly was around ESG and sustainability policies, and how, almost 7 out of 10 institutional investors plan to improve or strengthen their engagement with what they term poor ESG quality issuers. And so what you're looking at here is a chart. These are all the tactics that have been used in the past, or in 2016 rather. The slew of tools that they have in their toolkit and how they're planning to increase the use of these tools. And specifically, they say that they're going to identify and target issuers with poor ESG performance and policies and work with them to help them improve that performance, because they believe that's the key to unlocking value in those companies. So second trend I wanted to share with you is with respect to SASB. SASB standing for the Sustainable Accounting Standards Board. Many of you know about this, but I'm just going to make sure that if you don't know about it, make a note to Google SASB and get to know what they're up to. They've been around for about 5 years, working quietly in the background, and just last year, this is a U.S.-focused initiative to support U.S. investors into U.S. companies, support them in the application of ESG to their investment decisions. And what they're really trying to do is help the market understand what's material, what risks need to be taken into account, and how to apply some thinking around applying ESG risk to decision making. So SASB is chaired by Michael Bloomberg. There's a lot of serious heavy hitters on that board. And over the course of about 5 years, they worked industry by industry across 69 industries, developing specific standards on what that industry, if it's airlines, if it's automobile manufacturing, if it's computer chips, you name it, there is a standard there that helps issuers in that industry understand what could be potentially material to that industry and what investors would like that issuing company to look at and determine and disclose upon. So 43% of the investors in 2016 indicated in the U.S. that they preferred SASB as a framework. not a surprise given that it's meant to really focus on investor issues. 21% of them cited GRI, which is the Global Reporting Initiative. It's been around for a long time, and it addresses all of the stakeholder considerations around what could be important from an environmental social perspective. But most importantly, I think we need to know that so these standards were provisional standards that were released last year as drafts, and they've been taking comment, and now they're formalizing them, and they'll be releasing final frameworks this year. But in the meantime, an investor advisory group comprising all of these organizations, I think we all recognize them, they've all signed up to join this investor advisory group. And in so doing, they're committing to encouraging companies to disclose material and decision useful information as recommended by SASB. So they're lining up against SASB in the U.S. And not only in the U.S., I would say to my experience here is that it's North American wide in terms of the interest of SASB, and investors, institutional investors and asset managers pointing to SASB and saying that's the guide to work with. So layered on top of all that is what's been happening at the Financial Stability Board. The Financial Stability Board is chaired by Mark Carney, who is the governor of the Bank of England, of course, and the members of the Stability Board are all the other governors of the G20 banks. Over a year ago, Mark Carney issued a concept paper around the concept of the tragedy of the horizon, which basically means we're out of sync here. We've got climate change that's on one timeline, and we've got the public markets on quarter by quarter and annual timelines, and they don't connect. And he identified a looming risk to financial stability worldwide because of this. He struck a task force. He put Michael Bloomberg in charge as the chair, and again, a whole heavy roster of members of that board. And they just released their recommendations in December of 2016 back to the Financial Stability Board in terms of what they think is needed in order to mitigate this potential future climate change risk as it pertains to financial stability. The recommendations included that all issuers of all sizes, including banks, insurance companies, pension funds, endowments, foundations, asset owners, and asset managers, should include climate risk in their mainstream filings, and that they should be also running scenarios around if we hit 2 degrees, how will that impact our business, and in the case of asset owners, our portfolio and the performance of those portfolios. So that just hit the streets December 2016. They've wrapped up the comment period just a month ago, and the recommendations are going to be formally presented to the G20 just before the G20 meetings in June. Already we're seeing major institutions declaring that they're aligning to those guidelines. So Ron mentioned the UN PRI with 59 trillion in assets under management. Just a couple of weeks ago, Fidelity, which was one of their last holdouts, has announced that they've signed up to that initiative. JP Morgan has signed up to the US initiative. And this is all about investors saying we are going to commit, or we have committed to the application of ESG in our investment models and to the engagement with our issuer companies on best practices, and also the exchange between members of these initiatives. They're exchanging best practices and data to improve their ability to use ESG effectively. And I really need to make sure that we're aware of the Sustainable Development Goals. This is also referred to as the global goals. This is a universal call to action around 17 global goals that would protect the planet and poverty and ensure that all people are safe and enjoying some opportunity for prosperity. So, what does this have to do with you? Well, the leading corporate reporters are using these global goals to help them tell the story, the exciting story of what their ESG strategy is all about. So they're lining up against the goals that that line best against their strategy, and they're talking about how their business opportunities, market growth, and investment is aligned to these goals. So I'm pointing that out as a framework, as a tool to help with the narrative of ESG strategies. And just this afternoon, actually, we'll get the updated information on the 2017 proxy season, which will tell us where are these shareholder proposals focused. In 2016, more than half of the shareholder proposals were focused on environment issues and political activity, up from almost 40% in 2015. So I'm expecting this afternoon, with the release of that information, we're going to see a similar or higher trajectory in terms of where the proxy voting is going this year. So then on the global landscape again, in 2013, the EU agreed, all the member states agreed that by December 2016, they would have written into law in their national legal frameworks the requirement that companies with more than 500 employees must, in the 2017 financial year, include what they call non-financial information and diversity information in the disclosures. So they're talking about environmental, social, and employee matters, issues around human rights, anti-corruption, bribery, all that stuff now will be required in 2017 to be disclosed by companies with more than 500 employees in the U.S. And you see the GRI organization lining up against that, so they've just upgraded from guidelines to standards, which will help these companies the regulatory requirements in their own countries. And finally, last year, Morgan Stanley and Bloomberg conducted a survey of services companies around what they intend to do with respect to this whole movement. And of those that did not yet have sustainable investing products in the market last year, 6 out of 10 of them said that they were going to have them in 2017. So you already see Morningstar and Bloomberg and S&P and Morgan Stanley with their products, and we're about to learn now about MSCI.
Well, thank you, Susan. Before we move on to Eric, I have one question. I mentioned earlier, a lot of companies are reporting. There's an increase in CSR, sustainability reports, oftentimes following GRI. What do you think is the biggest gap between what these reports are delivering and what investors are actually, and particularly analysts, are looking for?
Well, I think it's the issue of materiality. And I'll get into that later in my discussions, but there is a lot of reporting going on, but investors are having a hard time wading through it all to figure out, well, what's material here to financial performance. And that's really the discussion that needs to be had is what we're talking about. It may be important to other stakeholders, and yes, there are forums for talking to those stakeholders about CSR, but from the investor's perspective, what are you talking about here that's going to impact current and future financial performance?
Great, thank you. Well, Eric, as someone who has to wade through this kind of information, tell us about how MSCI, looks at this information, compiles it, and then creates ratings.
Will do. Thanks, Ron. Hi, everyone. Yeah, so let me quickly give and thanks, Susan, for laying out sort of what's going on right now as far as disclosure. And as a quick introduction to MSCI and what we do. We're a global firm, and our strong suit is indexes. You may have heard of MSCI World, which is the index that portfolio managers benchmark against if they have a global portfolio. It covers mid and large cap developed market companies. We also have an emerging market index, and the combined MSCI All Country World Index is also the dominant benchmark for investing that includes emerging and developed markets. But we also have analytics products that we provide and are well known for, and really our clients are your investors. They're the largest pension funds in the world, the largest asset and the money managers that service those pension funds. So it's the largest asset managers and asset owners globally. We've been seeing a strong growth in interest in ESG products. When I started in this business in the 90s, I think we were a team of maybe 15 people doing exactly ESG research. Now we have over 250 people globally. As you can see, we serve, besides having over 1,000 clients, we serve 47 of the top 50 global asset managers. So really, as it's been said earlier, in ESG, the interest in ESG from the mainstream investment community has really come of age, and that, from my perspective, has really taken off, say, in the last 5 years. And we offer a full suite of ESG products. Some of you have asked for your ESG Ratings product, which is probably our dominant product, which assesses how well we think a company is managing its ESG risks and opportunities. But we also provide other ESG products and data that and have seen demand for those grow as well, whether it be carbon data, water data, or and data and analysis. We always package it with analysis, or some of the more traditional markets in the ESG space, such as screening services for those clients who are looking to avoid certain types of investments. Focusing here on the growth in the mainstream markets, how are the mainstream institutional investors taking up ESG into their analysis? They're really looking at ESG as a risk factor, all right? Complementary to that is looking at as a potential opportunity. But first and foremost, they're trying to understand how ESG impacts company performance over the mid to long term, and how there might be systemic or risks that traditional financial analysis is not really taking into account, and how well companies are prepared to manage those risks and to manage sort of some of the day-to-day events that and avoid some of the events that we see in the news pretty regularly. On top of all that, so that's environmental and social risks. We also look at how well companies are governed and look at some core metrics, kind of collect that across all sectors to understand governance quality within a firm. So let me go to the next slide. So how do we do that? How is this analysis organized? Well, there are a full range of environmental and social issues that one could apply to companies, and many of them would seem relevant. And we organize it traditionally, as you might imagine, on an E and S and G category with some core themes beneath each category, as you can see from this chart. But within our model, we, at an industry level, we identify what we think are the most material or significant key issues that a company will face, and we focus our assessment model on those limited set of key issues. And that's the message we've heard certainly from investors and from our clients, is that that's what they want to focus on. They really would rather not bring in other issues that may have some minor importance, but really, from an investment standpoint, become a bit of noise in their investment strategy. So how do we do that? I think we'll cover that next. Is how do we, well, let me just first focus on one issue that we cover for all companies. Again, just reiterating that we collect this information from your public documents and we do a comparison globally and also through home markets of how well companies are governing these 4 core issues. And this is something that, again, we can compare for all sectors. But when we're drilling down amongst our sort of library of key issues that we, in the environmental or social categories that we want to apply to a particular company, what we do is we look at the industry first, and we look at the terminology we use as externalities. What are the most prominent externalities for these industries within the environmental or the social category, and we rank all industries using some publicly available metrics from various data sources. So, for example, here on carbon emissions or water stress or health and safety data, we collect that data for all sectors, and we have a ranking methodology, and basically the companies that are most exposed on these metrics, the industries that are most exposed in those with these metrics, according to these metrics and these rankings, are selected to have those issues assigned to it, and therefore we will be investigating those issues, and our analysts will be looking at management performance on those issues for those companies that fall into the relevant industries. Just as an aside, MSCI, we use the GICS industry classification system, so your company would be assigned to an industry according to a GICS nomenclature, their system. We actually are a 50% owner of GICS with S&P, so if you have an issue with your classification, you can certainly let us know, and we can communicate that to GICS. But again, the point being is that materiality or significance, depending on what type of terminology you want to use, we assign that at an industry level, and we look at data that we've collected from a variety of public sources to establish what we think are the industries with the heaviest footprints, if you will, across these issues. Now, how in our ratings model, once we've assigned an issue to an industry, in our model, what weight do we apply to that issue? And there we look at the level of contribution to the externality, the footprint analysis, if you will, of that industry. Again, this is at an industry level. And then we look at the likelihood, we think, of that externality having impact on the industry within a short, medium, or long-term time frame. And that allows us, again, at an industry level, to set the weights for the model. So if you're looking at your ESG ratings report, if you happen to be able to receive that from us recently, you can see the weights, and if and I'll get to this, but if there's no variation from that due to company-specific reasons, the weight for that key issue is determined at the industry level by these considerations. So once we've determined the sort of industry level weights and the industry level issues and the weights have been assigned, then we start looking at specific company variations on that. So what the company key issues could change depending on the particular business segments the companies are involved with. So there's some wiggle room there, and also where the company's operations are located. That could change the weight of the issue as well, and the importance of the issue as well. And then on the other side, once we've established the set of key issues that are relevant for a company, we go into actually analyzing how well a company is managing those risks and potentially opportunities. And that's really the bread and butter, I think, of what we're talking about in this webinar, is really how could companies disclose in the key areas that investors are interested in, and disclose on how well they're managing these risks and opportunities. So let's go into a little bit more depth there. And these, I hope, are familiar to some of you if you're an experienced sustainability person at your firm, or if you're in investor relations and you've had a chance of engaging with us or other ESG research firms. But fundamentally, we're looking for, and others like MSCI are looking for, how well companies have articulated their policy commitments on a particular issue, how well they've articulated and introduced innovations and programs that have specific targets to manage these risks or take advantage of certain opportunities, and then performance. So sort of the 3 Ps, policies, programs, and performance. How well are you meeting those targets, reducing your footprint, taking advantage of opportunities? And disclosure on each of these 3 components of the risk management score obviously is crucial. And from our perspective, it has to be public, and the more comprehensive it is, the better. The more on the performance, the more comprehensive and complete and over a longer time frame you have data on, the better. If it's consistent with commonly accepted global or national standards, that's also for the better. But this is fundamentally, across all the issues that we look at, the fundamental structure of the management assessment process that we go through. We look at the policies, the programs, and the performance. Happy to answer questions on that in the Q&A. And then finally, I'll just focus on with MSCI, how we engage with issuers on their disclosure and across all the products that we create in part off of the disclosure. We of course use a number of other sources as well, but a company disclosure, public documents are crucial to that process. So for just taking the ESG ratings product, that we do this for all of our products, we do have a very proactive program where when your industry is up for review, and we review each industry once a year, where we really dig into the issues, and the analyst compares all the companies in the peer set. We will alert you when your industry is up for review in the upcoming quarter, and then encourage you to engage with us on these issues. And then we will also send you after the analyst has collected all the data. We don't do surveys. Analysts collect the data. They go up, see what's available from your sustainability reports, see what's on your website. They do all the work themselves. We're not asking you to fill out a 75-page survey, but we would like you to fact check what we've collected. So we'll send you a data report that's only for issuers, not for our clients, and it's just the data. It doesn't have the scores and ratings, so we send you those reports too upon request, and when we send you the alert, we'll send you what our clients are seeing at the moment. But we also send you a data report once the analyst has completed that process, and we ask for you to review it and just confirm the data, or let us know if we've missed something, or if you don't understand something, let us know. So but just to, I'm going to end here because I know we want to get to some questions. But once we've finished that industry review, the 1 or 2 month period, depending on the size of the industry, for the remaining months of the year, we're also open to engagement at any time, really. The analyst who did your company may have moved on to another industry, but they do have time set aside to make adjustments, to update issues. What we can't guarantee is if you've come out with a full sustainability report, that they would have to be able to process every part of that, but we would certainly be able to process some of the highlights. So really, I'm going to turn it back to you, Ron. I think that's it for me for the moment.
Okay, well, thank you, Eric. And I do want to remind the audience that you can submit questions by just typing it in the Q&A pod down in the bottom right-hand corner, and we'll get to those at the end of Susan's next section. Those will come directly to us, and I appreciate the ones that have been submitted so far. Eric, before I move on, I do have a question. You see a lot of data disclosed by different companies, what would you say is maybe the most common shortcoming of the information that that you get through the public disclosure?
Good question. I would say still probably one of the common shortcomings, there's two really. One is companies tend to just focus on the positives and ignore some of the potential challenges. And if you ignore the challenges, or we won't, and other organizations who are doing ratings analysis won't ignore the challenges, and that information's out there. So be sure to to cover both. And second, I would say is sort of institutional memory is often there's maybe turnover, maybe there's change in the IR or the sustainability staff, and it's surprising to me how many times the handoff isn't smooth, and an issuer will forget, will not realize how they've communicated with us in the past.
All right. Well, Susan, do you have advice on how issuers can be more effective in meeting ERIC's needs?
Yeah, well, I think I'd start with talking about the pain point, which I think we all know is out there, and there's just the common problem cited by investors, and here is just a really compelling statement where this fellow from CalSTRS is saying they are screaming for consistency. Now, we're not going to get consistency. That's just a fact. For at least for a time in North America, we're not going to get it from the regulatory environment. So it really behooves the issuers to do something about owning the narrative and owning the information, because as Eric has suggested, that they're going to find what they can and use it to create their own storyline on what they think your ESG risk and opportunity is. So best to take control of the conversation. This comment here also talks about things being buried in footnotes and boilerplate, and it's junk. It's just not useful for these entities to make risk and opportunity evaluations and to make money. Ultimately, that's what they're talking about. So I like to share this because I think it just really drives home the point. These are all the obvious places where analysts look for information in the public domain. Now, they also look elsewhere, but they definitely make sure that they're tracking what's coming out from third-party providers in your press, in your CSR report, your filings, your website. They're looking at all this stuff, and they're feeding that into the models that they've been developing for the last 10 or more years, and refining and gaining quite a bit of confidence in how they're using those models now. So these are the 4 questions that I've picked up in listening to analysts. Most recently, I was listening to the head of ESG for State Street, and sort of, what's their framework like? And essentially, there's 4 questions. Has the company identified material issues with respect to E&S, environmental and social? Have they assessed these issues and incorporated them into strategy? Are they communicating these issues in their filings and elsewhere? And is there governance at the board level? So on that first question, material issues, I encourage issuers to look at SASB. They've done a lot of the hard work. It certainly sets a baseline. If you look at that and you see in your industry what SASB's identified as material topics, you can see how thoughtful their process is and how relevant it is to each industry. So, here's airlines on the left, 4 topics. Now, within those topics, there are specific metrics that they recommend an issuing company track and disclose, but 4 topics for airlines, and on meat and dairy, quite a number more, and they specifically align to the nature of the business that the company is in. So I think it's really important to use the tools that are out there to get a head start on the work that you want to do, and don't reinvent the wheel and sort of go internal and try to figure it out all by yourself. Here's an example of what we're talking about in terms of evidence that ESG is incorporated into strategy. On the left, you have anonymous company A that have a great CSR report when they talk at length about the things that they're doing around human capital, HR programs, engagement, attraction, retention, the good stuff they're doing there. But there's no real goals or ties to financial impact that are communicated in the CSR report or anywhere else, as in financial filings. So not a good indication that it's really strategically managed, even though they've said, hey, this is really critical to our business. And then you have Company B that have said in their financial filings, we've identified weather patterns as a material risk, and not in a boilerplate way where they've actually said, and here's how it's affected our bottom line in the last year due to, a number of 100-year flood events or whatever the weather patterns were, how it affected their bottom line, how it might affect their future bottom line, what initiatives they've got underway to adapt to that, and what metrics they're tracking. And they're communicating this in their sustainability reporting as well as their financial reporting. So that's, sort of best practice Company B. And when the third question that a State Street style analyst might ask is, where's the consistency? Is there consistency across channels? So here you see a company's disclosures and the various topics on the left and the different channels where they might communicate on these topics. And they might have really specific metrics, say for GHG emissions across the board, and that's great. But then if you go down, you see under social capital, they've got some boilerplate language, which as those who are analysts say, they can't do anything with boilerplate language. So it's boilerplate in their filings, and it's industry specific in their CSR report. Some lack of alignment there. And that's just that nobody's got this perfect yet. It's still a moving field, but these are just really obvious opportunities to up your game. And then the fourth question an analyst would ask is, do we see evidence at the board level that this is being governed? The G part of the ESG is establish best practice, and people pretty much know what's expected and what the structures are and how that should be communicated in their filings, or in any of their materials. But on the E and F side, it's been found that less than half of the companies in the S&P 500 have any kind of governance structure for those topics. And so that's an area of concern for investors for sure. And also there's an expectation that the board have literacy on this material, not only that you do have a committee that's responsible for this information and for managing it, but also that the board overall has literacy around this topic. And we're seeing quite a bit of movement around bringing material and bringing training basically to the board to create literacy. So these are the 5 steps that I suggest companies undertake to really improve upon their investor communications. And the first is go back and look at your top institutional investors and do the work to determine which of them are signed up to any of the investor initiatives that I mentioned earlier in this discussion, but also talk to some of them and find out maybe, what are they doing about this? How are they applying this? Like understand your institutional investors and how they fit into the ESG world. And then there's the benchmarking. Eric referenced that as well. They look at how you are performing in the industry as compared to peers. So you want to know what your ESG disclosure quality is, not just what that you're disclosing, but what your performance is relative to your peers and to the industry. And then the third step would be to agree internally on, okay, which of these topics do we really recognize as material to our business? And there are some best practices around how you do that. And then you can determine what you're ready to disclose now. What information do you have now that you consider to be good enough quality to share? And what do you need to develop some programs and initiatives around and targets and that sort of thing to show to your audience of investors that you've got this, you're managing it, and you're moving in a direction to meet some strategic goals. And then finally, there's a number of opportunities around what you can do to right away improve your investor communications. So I talk about the concept of the ESG brand. You can do some looking around, some work around understanding what is the market sentiment of your ESG footprint now, using some research tools and some social listening tactics. Also looking at what policies you have already that maybe you're just not communicating them. You could have a lot of this ground covered, at least in terms of having the policies in place, but if they're not being communicated to the market, they don't improve your ESG brand. So that's an easy way to get started. In terms of an actual program, this is a list of sort of do's, things you can do, starting with some of the easier stuff and moving to things that might take a little more investment of time, but certainly an investor page where you're starting to talk about this information at a high level, including ESG language in your current, if you have any sustainability reporting, to start to make the language the same in different documents and finding those opportunities to create alignment between the different vehicles that you're using to communicate publicly. There are things you can do around socializing ESG internally, so people are talking the language and starting to think about it as part of their day-to-day work, as well as socializing it in the external markets. Third-party verification is really key. Investors certainly want to see you disclosing, but they also want to see that the information you're disclosing is using the best practices that are recognized for how you track that particular data or information. So for key material issues, it's good to be thinking about putting the right data collection approaches in place so that at some point it can be verified or audited and provide your investors with better comfort around the numbers you're putting out there. And then, getting further down the line, eventually including ESG in your investor presentations that is total best practice, and updating dynamically, not annually. Don't wait to the end of each period to tell that ESG story, but give the updates on a regular basis so your investors can see the progress you're making quarter by quarter, day by day. And that concludes my presentation.
Well, thank you, Susan. Again, a reminder, if you have a question, please use the Q&A box that's found in the bottom right-hand corner. And first question I have, Susan, is for you. And you mentioned earlier in your presentation comparing SASB, the interest that investors have in SASB information versus GRI reporting. And the question is, have you seen any signs of companies using SASB in their sustainability reporting?
Yes, I mean, SASB's end goal here is to see it in the filings, which it seems to be, that's what the Financial Stability Board's recommendations are too. So, and that's what we're seeing with the the EU directive. So that's where it's headed, recognizing it's going to take a few years to get there. But in the meantime, SASB released their draft standards in early 2016, and already in 2016, about a dozen American companies included references to SASB in their sustainability reports, so they're dipping their toe in the water. I know that there's a bunch more that are going to come on stream this year, showing the use of SASB as a guiding framework in their sustainability reporting, and some are going to be moving to actually including SASB information in their SEC filings this year. So it's interesting because it was only draft recommendations last year. It's this year when they're finalizing them, but already, the leaders are really jumping on this.
Now, is there a feeling that integrated reporting will help satisfy investor interest in ESG versus, the more standard approach of having a separate sustainability report and a separate annual report?
Well, it will certainly help investors, but I think there still will be a need for a separate sustainability report for other audiences. But I think, the expectation is in time, that's where we're headed. That's probably yet another step away from let's get it into your filings, and then expand upon that to requiring integrated reporting.
I have a question for you, Eric. You mentioned in your presentation the policies, programs, and performance being three areas where you look at disclosure in developing your ratings. Is there one of those areas more than the others that you feel companies are maybe lagging in their disclosure, or perhaps the quality of that disclosure?
I would say performance is the hardest area for issuers to report on. And, it's hard to gather all that data and to do it, year over year. It's also, but it's probably the most consequential, certainly in our model, because it's really where, you're sort of walking the walk, if you will. It's sort of the proof of how well you're implementing whatever programs you've initiated and commitments you have. So I would say on the performance side.
Okay. And where do you typically get that kind of information?
Performance data is company disclosure, or if they've used CDP, we'll definitely use CDP, but it's really based on company reporting.
Okay. And as you sift through all this data, do you feel like is the issue a lack of quantity of information coming from companies, or more of a lack of quality?
It's a little bit of both. I mean, consider we cover a lot of companies. We cover so larger companies. There's still many large companies that don't have the quantity of disclosures that you would expect from some of the larger firms. But then you're getting into quality comparisons between those who are very good reporters and your peer set. Essentially, that's what you're up against, sort of best-in-class reporting. When you get into the smaller companies, then it's just an issue of reporting, of a quantity of reporting. It's often just a lesser amount reported in the smaller cap companies.
Okay, great. Susan, I think this next question probably fits you the best, but this is from someone who is a sustainability director, and they're wondering, any advice on approaching the investor relations group within their company, because they're generating that information, but as we're pointing out today, there needs to be that consistency between what the sustainability group would be reporting and what investor relations should be representing to their investors. So you have any advice on that?
Yeah, I think, well, that's been identified as the number one challenge for companies, is that the IR folks speak one language and think, have a certain mindset and certain things that they deal with that don't overlap with the sustainability people, and they have different time frames. So IR people are in the quarter-by-quarter annual cycles, and CSR initiatives usually run over longer time frames. So I would recommend that CSR people do some of the advanced work for their IR peers. Do that, look at who the investors are, create the business case from an IR perspective, and then walk across the aisle and share that with them, and to show them that the work that they're doing on the CSR side can really help them with their IR investor engagement activities. So those 5 steps I outlined, starting with knowing who your investors are and which initiatives they're signed up with, look at the ESG as opposed to the CSR information that's out in the public domain, look at how it lines up against SASB, do some of that groundwork, and then prepare that sort of a briefing package, so to speak, to share with the IR folks and give them a head start, and offer to collaborate and support their work, because it's, we live in this world of sustainability, and it's second nature, and the language that we use is second nature, but we have to, if we're going to succeed in moving this dialogue across the organization, apply other types of business language, adapt our language to the IR frameworks, and make it intelligible for them, help them advance this.
Great. And Eric, what would be your top 3 things you think an issuer could do immediately to help improve their scores and provide you with the information that you desire to be more accurate in that scoring?
Top 3. Well, first is engage. As it's been noted earlier, the story is going to be told by whether it's MSCI ESG Research or one of the other ESG ratings houses out there, or by analysts. For many asset managers have their own staff now, and who work with their portfolio managers, and more you get portfolio managers who know ESG, and they're going to be looking. They're going to be looking for this data. So engage with the major ESG research providers, such as ourselves, and understand what's being asked, and then engage with, I guess, second would be engage with the standards organizations. As Susan said, SASB is doing great work. Of course, GRI is the dominant standard out there globally, and understand these initiatives that are coming around carbon and water. So I would say that would be the second thing. Be aware of the trends and best-of-class reporting trends on the issues. And then I guess the third best would be, once you've engaged, just keep engaged and pick your the limited set of investors or organizations that you want to engage with, and really stay engaged over time.
Great. And with the minute we have left, Susan, what would be your top 3 things someone getting off of this webinar and has an interest in improving their ESG disclosure and scoring, what they could do?
Oh boy. Well, I think I go back to SASB. It's there. You can quickly do a checkup on what they have identified as material and see if you think your organization has any or all or some capacity to line up against those topics. And then the second of the top 3 would look at your institutional investors right now. You can probably go and get that immediately, and there's a little bit of work to do in terms of how you do the research to find out who signed up where, but that would be another quick and dirty step. And then I think that it's about putting your business case together to advance this. If you're on the IR side, certainly have lunch with the CSR lead and tell them what you're thinking about, and talk about how you can work together, get the business case together. And similarly with the CSR side, have lunch with your IR people and offer to support, because I think this is where it gets pushed up to the board level, and really good work happens then, because the right resources and the right focus and strategic integration happens when your C-suite and board level understand what's going on here.
Great. Well, with that, I'd like to thank our audience for participating in today's webinar. There's some links down in the bottom left-hand corner if you'd like to contact the presenting organizations here today, as well as the part 1 of our ESG series, Preparing for ESG Disclosure. So with that, I'd like to thank our guests, Susan and Eric, and I wish everyone a good day. Thank you.